Silver just went from the high 40s and low 50s per ounce to a closing high of about $116 in roughly 3 months. Then it cratered $30 in a single session. And right now, mid-February 2026, it is sitting in the high 70s, acting like nothing happened. Something doesn't add up here. Let me show you what is actually going on, because the narrative around this market right now is missing half the picture. We need to address what the supply chain data is telling us, and towards the end, I'm going to show you exactly why the next few weeks will decide the entire tone of silver for the rest of the year. Now let me lay this out for two different kinds of people watching. If you are a long-term stacker, somebody who thinks in years and decades this current window between $70 and $80 should look like a gift wrapped in volatility, you're getting an asset that was north of $100 less than a month ago at a steep markdown. The day-to-day whiplash is noise for you. Your job right now is simple. Keep accumulating at a measured pace. Do not blow your whole budget in one purchase, and ignore the intraday drama. But if you are a short-term trader, especially anyone using leverage, this range is a wood chipper. $3 to $4 swings overnight, gap downs at the Asian Open, margin repricing with zero warning. That kind of environment will liquidate you before your morning coffee gets cold. Know which camp you sit in before you do anything. Seriously, write it down if you have to. Let me rewind the tape. Back in late October 2025, silver was hovering around $50 an ounce. Nothing spectacular, steady. Then the buying started, and it was not gentle. Over roughly 10 weeks, the price ripped from 50 to north of 116. That is more than a 130% gain in the time it takes most people to finish a quarterly review at work. For context, during the famous 2011 spike, silver climbed from the low to mid-20s to nearly $50 over roughly 7 months. This recent run, from about 50 in late October to over 116 by late January, covered similar or greater percentage ground in closer to 3 months. Think about what that means for a second. The velocity of this rally outpaced the most legendary precious metals move of the last 2 decades. That does not happen because a few Reddit threads got excited. That happens because real capital, institutional capital, was chasing supply that simply was not there. January 28th, the price tagged $116.61. Let me say that again, $116 on an asset that was around $50 barely 3 months earlier. That peak triggered something. Whether you want to call it profit-taking, margin liquidation, or coordinated flush, the result was the same. 2 trading days later, the air came out. From a close, just above 116 on January 29th, to roughly $85 by the end of January 30th, nearly $30 vanished in 24 hours. That was about a 26% haircut in a single session, the worst one-day percentage drop in modern silver history. For context, the single worst day during the 2011 crash was about 12%. This was more than double that pace, and the exchanges did not exactly stand around watching. Margin requirements tend to get raised right at the point of maximum pain, which forces leveraged longs to either post more collateral instantly or get closed out. We will come back to that dynamic because it matters a lot more than people realize. And then came another leg down in early February. On February 4th, we were closing just under $90. By the end of February 5th, silver settled in the high 60s, roughly a $20 plus drop and around a 25% hit in a single day. Back-to-back gut punches inside of a week. Back-to-back gut punches inside of a week. Since then, the metal has mostly chopped between the low 70s and mid-80s. If you zoom into a 1-month chart right now, the closes look like a tight sideways cluster with sharp intraday spikes that get forgotten by the next session. Looks calm, looks resolved, looks like the party is over. But is it? So here's the question everyone is asking. Is the silver rally finished? Did we see the top and now it is just slow bleeding from here? Most people think the excitement is over because the chart cooled off. In reality, the physical market underneath is telling a completely different story. And this is where the picture fractures into 2 competing versions of what is happening. One reality lives on the screen. The futures chart, the spot ticker, well, it's the paper contracts bouncing between 70 and 80. That version says things calmed down, volatility contracted, the fever broke. Move along. The second reality exists in warehouses, at refinery loading docks, and on the phones between wholesale dealers trying to source product. That version has not completely calmed down. High-volume products like new Silver Eagles and a lot of 1-ounce rounds are still seeing multi-week weights and chunky premiums at many dealers, even while other corners of the market, like big bars and older junk silver, are actually seeing more selling than buying. On the charts, it looks like equilibrium. On the ground, it still feels like a logjam in those high traffic lanes. Both of those cannot be true forever. During that 10-week run from 50 to 116, almost every major online bullion retailer posted delay notices on their websites. Massive demand warnings, extended shipping timelines. We are talking the big names across the industry. And if you check those same sites today in mid-February, most of those notices have vanished, pulled down, gone. On the surface, that looks like proof the frenzy is dead. But dig one layer deeper, and the ground tells a different story. Multiple wholesalers are still reporting 1 to 2 week lead times on staple products like generic rounds and American Silver Eagles. That backlog did not materialize from thin air, and it does not vanish just because a few retail websites took down a banner. Here's what you need to understand about how physical supply chains work, because this is the part almost nobody talks about. Refineries operate on a queue. When demand spikes, that queue fills up. But just because retail orders slow down for a week does not mean the refinery queue resets overnight. The metal still has to be melted, assayed, purity tested, stamped, packed, and shipped. All of that takes time regardless of what the spot chart is doing today. It is like a highway on ramp after a traffic jam. The entrance ramp might be empty, but the highway itself is still bumper to bumper for miles ahead. The processing backlog built during November, December, and January represents real physical inventory that has to move through real physical steps. You cannot speed that up with an algorithm. And here's a detail worth chewing on. January 2026 saw one of the strongest monthly bursts of physical silver demand in years, and American Silver Eagles were right at the center of it. The Mint's own price hikes and temporary sales pauses, alongside dealer reports, tell you blanks were getting pulled hard. But those blanks have to come from somewhere. The Mint sources its planchers from specific approved suppliers, and when the Mint is pulling hard, it competes with private mints and refineries for the same refined silver. That upstream competition does not just disappear when the spot price dips $10. Wholesalers face the same bottleneck from the other direction. Even if new retail orders shrink, the multi-week lead times generated by the surge do not just evaporate. The pipeline has momentum, and the products that feel the squeeze longest are always the highest volume items. Generic rounds, Silver Eagles, the bread and butter of physical stacking. They get hammered first when demand surges, and they normalize last. That pattern is repeated in every silver squeeze going back to 2011 and again in 2020. So we have a paper market that looks like it is napping and a physical pipeline that is still digesting a feast. One of them is lying, and it is not the one that involves actual metal moving through actual buildings. Now, let me talk about premiums for a minute because this connects directly. When you see silver quoted at $78 spot, and then you go online or call your local coin shop and the price for a single Silver Eagle is $95 or $97, and that gap is the premium. And premiums right now are still elevated across the board. Rounds that normally carry a $2 to $3 markup are sitting at $5 or $6. Eagles are even worse. That spread is basically a tax on urgency, and it tells you something important. Dealers are not confident they can restock cheaply or quickly, so they build a cushion into every sale. When premiums normalize, it means the supply chain has caught up. We are not there yet, not even close. And here's a frustrating truth for stackers. You might see the spot price at 75 and feel like you're getting a deal compared to 116. But if the premium adds another $20, you're actually paying 95 effective dollars per ounce on an Eagle. That math frustrates people. It should. But the premium is not arbitrary. It reflects the real bottleneck between paper price and finished physical product. Ignore it at your own expense. All right. Here's what I consider the most critical part of this entire breakdown. And it is about the psychology driving this market right now. If you understand this, you understand where demand goes next. And that matters more than any chart pattern. During that 3-month moonshot, you had 2 tribes operating at the same time. Tribe 1 was the conviction buyers. Full send, every paycheck into silver. Do not wait for dips. Do not comparison shop. Just acquire metal as fast as possible before the price doubled again. These folks were driven by fear of missing the boat, and honestly, the chart was validating them every single week. Each Friday was higher than the last. The momentum felt unstoppable. Tribe 2 was the opposite, the scar tissue crowd. These were people who got burned in 2012. Silver had spiked to nearly 50 in April of 2011, and then spent the next 18 months grinding back to the low 20s. That collapse burned an entire generation of stackers. Some of them held for over a decade just to get back to break even. So when they saw silver climbing past 80, 90, 100, their muscle memory kicked in. Sell, lock in profits, protect capital. Do not let 2012 repeat itself. And looking at the chart, the scar tissue crowd had pretty solid timing. They sold into strength and the correction arrived almost on cue. 116 became 85 practically overnight. But here is the mid-script reveal that reframes this entire situation. After that crash, the 2 tribes swapped roles completely. This was not a standard correction. It was a mass psychological rotation. The conviction buyers, Tribe 1, did not dump their silver at 85. Think about it. They loaded up at 90, 100, 110 because they believed silver was heading much higher. A drop to 85 does not change that belief. It just makes their cost basis painful. So they froze, stopped buying, stopped selling, just white-knuckled their positions. The scar tissue crowd, Tribe 2, suddenly saw what they had been waiting for. A violent crash. Confirmation that the 2012 pattern had repeated. And paradoxically, that crash made them feel safe to re-enter. They had cash from selling the top, and now the price was $30 to $40 lower. So they started loading up. One dealer I follow closely illustrates this perfectly. 1 week, he was drowning in inventory. Could not move it. Refiners were turning product away. Wholesalers were saturated. He was practically giving away metal at wholesale cost just to lighten the load. 7 days later, after the crash hit, he reported that he had sold through nearly everything, went from completely overloaded to almost empty in a single week. That reversal was not random. It was the two tribes changing seats at the exact same moment. And this rotation explains the current state of apparent quiet. The conviction crowd has gone silent because the chart punished them. The scar tissue crowd already reloaded on the dip and feels no urgency to buy more. Both groups are now in a wait and see posture. And when both tribes pause simultaneously, volume drops, price compresses into a narrow range, and on the surface, everything looks boring. But boring in silver is almost always a loaded spring. Historically, every prolonged consolidation in precious metals between two clean levels has resolved with a violent breakout in one direction or the other. The 2013 to 2015 range in gold between roughly 1100 and 1250 preceded a move above 1900. Silver's own 2019 to 2020 range between 14 and 19 preceded the run to nearly 30 in 2021. Tight ranges do not resolve quietly, they resolve violently. Let me give you the bearish scenario first. If silver breaks below 70 convincingly, say on heavy volume, with a weekly close under that level, then the next logical support sits around 62 to 65. That would represent a roughly 45% retracement from the peak, which actually mirrors the proportional pullback silver made after 2011. For long-term stackers, that is a generational buying opportunity measured in years. Lower prices, lower premiums eventually, and more ounces per dollar. For leveraged traders, that is a margin call and potentially a total wipeout, full stop. Now the bullish scenario. If 70 holds as a floor through February and into March, and you see 2 or 3 weekly closes above 80 with expanding volume, the path back toward 95 to 100 opens up relatively quickly. The supply chain backlog we discussed would confirm that physical demand never actually died, it just paused for breath. And if that physical demand resurfaces while the pipeline is still congested, premiums explode higher and the disconnect between paper price and real metal gets even wider. For stackers, that means buy sooner rather than later because your effective cost only goes up. For traders, a confirmed breakout above 80 with volume gives you a defined risk entry with a stop just below 70. Now here is the structural force working behind the scenes that most people underestimate. The exchanges and the large commercial short holders benefit enormously from volatility that punishes retail participants. Every time silver drops $10 in a day, leveraged longs get liquidated. Those liquidations are not money that disappears. Somebody on the other side of that trade collects that margin. When the exchange raises collateral requirements at the exact moment retail is most exposed, it forces a wave of selling that has nothing to do with supply, demand, or fundamentals. It is mechanical. It is predictable for anyone with a big enough balance sheet. And it happens in silver with almost clockwork regularity around major delivery months. That is not conspiracy. That is just the architecture of a leveraged derivatives market where the house sets the rules mid-game. Your risk as a viewer is straightforward. If you use leverage in this environment, you are handing ammunition to entities with deeper pockets and faster execution than you will ever have. So where does this leave us? 3 things to carry with you, and we are done. Number 1, physical demand did not evaporate. It rotated. The buying tribe changed, the direction of flow reversed, but actual metal is still moving through the system in a way that keeps parts of the pipeline under stress. Wholesaler and dealer lead times on certain products confirm there is still strain in those areas. Do not confuse a quieter front end on retail websites with a fully normalized supply chain. Number 2, the $70 to $80 range is not stability. It is compression. 2 exhausted forces pressing against each other in a tight band. Compression in commodities does not resolve with a gentle drift sideways. It resolves with a breakout. Watch weekly closes and volume, not the intraday noise that shakes you out of positions. Number 3, premiums remain elevated and will not normalize until the refinery and wholesaler queue fully clears. If we stay range-bound for another 3 to 4 weeks, lead times should start to shrink and premiums should begin to ease. But if another demand wave hits before that queue empties, premiums could jump to levels that make a $20 markup on a Silver Eagle look routine. That would mean paying close to $100 for a single ounce coin while spot sits at 75. The gap between the paper world and the physical world would become impossible to ignore. And that leaves the unresolved question hanging over this entire market. Does the physical reality finally overpower the paper pricing mechanism? Or do we get one more engineered flush below 70 before the next legitimate leg higher? Nobody can answer that with certainty right now. And anyone who tells you they can is either selling you a subscription or managing a book that needs your liquidity on the other side. This is not financial advice. This is a framework for thinking about what is actually happening underneath the surface of a market that is far less boring than the chart suggests. If you trade this, especially with leverage, treat the current range like a minefield with a map that keeps changing. Have a plan. Know your exit before your entry. Size your positions small enough that a $30 overnight move does not end your month. Tell me in the comments. Do you think 70 holds as the floor, or are we going to see one more shakeout into the 60s before the real move begins? I want to know what you're seeing from where you sit. Hit the thumbs up if this breakdown helped you think more clearly about the situation, and subscribe if you want this kind of analysis without the hype attached. That is all I have got. Stay sharp out there, and we will talk soon.